Welcome to The Explainer, where we break down the big ideas that shape our world. Today, we're digging into a huge divide in the investment universe, the split between the physical stuff you can actually touch and the digital promises that drive the markets. Okay, so let's just jump right in with a really basic question. When you invest your money, what are you really buying? What gives an asset its value in the first place? Well, the answer isn't as straightforward as you'd think, and it basically splits the entire world of investing right down the middle.
You see, on one side, you've got things you can physically hold in your hands. A piece of property, a bar of gold, a tractor. And on the other side, you've got a promise on a screen, a stock, a bond, basically a digital IOU and a ledger somewhere. And believe me, this one simple difference changes everything about how an asset behaves, especially when things get rocky.
So let's get into the nitty-gritty of how these two worlds are defined and what makes them so fundamentally different. Because honestly, understanding this distinction is probably the most important first step you can take to build a portfolio that can weather any storm. All right, first up, real assets. Some people call them hard assets, and they have what we call intrinsic value. Think about it. You can't just print more farmland, right? You can't magically create another ton of copper. Their value comes from the fact that they're physically useful and, crucially, they're scarce. That gives them a kind of baseline value that doesn't really care what the stock market is doing on any given day.
Financial assets, on the other hand, well, they're basically promises. A share of stock is just a claim on a company's future profits. A bond? It's a claim on its future cash flows. So their value is extrinsic. It completely depends on some company or government's ability and willingness to make good on that promise.
And this is where you really start to see the trade-offs. Sure, financial assets are super liquid. You can buy or sell them with a click. But, and this is a big but, they come with high counterparty risk. That just means their value is someone else's liability. Real assets are the opposite. They can be a pain to sell quickly, but if you own them directly, that counterparty risk pretty much vanishes.
Now, this isn't just some academic theory. This distinction has been the driving force behind a constant tug-of-war for market dominance for the better part of a century. You've got each asset class taking turns in the spotlight, all depending on what's happening in the broader economy.
And the whole game changed at this one pivotal moment. In 1971, the U.S. cut the dollar's last tie to gold, completely blowing up the Bretton Woods system. All of a sudden, for the first time in history, every single currency in the world was pure fiat, backed by nothing more than a government's promise. And that unleashed a whole new era of volatility and inflation. The impact was just staggering. Before 1971, gold was officially pegged at $35 an ounce. By 2024, its price had rocketed up over 9,600%. Now, this wasn't just a price change. It was a fundamental rethink of what a real physical asset is worth in a world of floating digital promises.
And you can see how this played out over the next few decades. The wild inflation of the 1970s? That was a golden age for real assets. Then the pendulum swung back. The calmer, disinflationary 80s and 90s created a massive boom for financial assets like stocks. And then in the 2000s, what some people call the lost decade for stocks? Yep, you guessed it. Real assets were king again. Okay, to make this all a bit more concrete, let's really zoom in and put a spotlight on a couple of classic real assets that perfectly illustrate these ideas: farmland and gold. Let's start with farmland. It's such a powerful example because its supply isn't just limited, it's actually shrinking as cities expand. It's a productive asset that creates real stuff, food, and its value is tied to something the world will absolutely always need. And the way it makes money is just beautifully simple. Typically, about half of your return comes from lease income. That's the cash rent farmers pay to use the land. The other half comes from the land itself just steadily going up in value. It's this perfect blend of steady income and long-term growth, all anchored in the soil.
Now, gold is a really unique case. On the one hand, it's an industrial commodity. It's used in electronics, in dentistry. But it's also a financial asset that has zero counterparty risk. See, unlike a stock or a bond, a bar of gold isn't anyone else's liability. And how you own it makes a huge difference. A gold ETF is easy, right? It gives you exposure to the price with just a click. But it brings back that counterparty risk. You're now relying on a fund manager, a custodian, a whole chain of institutions.
owning the physical bullion yourself, that just cuts out the middleman. You hold the actual asset, period.
And this quote really gets to the heart of its value. Physical gold doesn't need a well-run financial system to be worth something. It doesn't need a CEO to hit their targets or a government to stay solvent. It just exists. And that's exactly why it's been a safe haven for thousands of years.
Okay, so what in the world does all this mean for an investor today? Well, the modern playbook isn't really about picking a side here. It's about strategically building a bridge between these two worlds.
For decades, the go-to answer for everyone was the 60-40 portfolio. 60% in stocks, 40% in bonds. But here's the thing. That model was built during a 40-year bull market for bonds that's, well, it's over now. In this new era of higher inflation, we're seeing stocks and bonds fall at the same time, which kind of defeats the whole purpose of diversifying. Here it is, that classic model. And look, it was designed for a very specific time of stable growth and falling inflation. And for a very long time, it worked like a charm.
And this is the evolution. To adapt to this new reality, the really smart institutional investors are now carving out a dedicated piece of their portfolios, usually somewhere between 5 and 15%, specifically for real assets and alternatives to hedge against these new risks.
So maybe the best way to think about your portfolio is like this. Your financial assets, your stocks and bonds, they're your engine. They provide that high-octane growth potential to really build your wealth. But your real assets, they're your anchor. They provide the stability to make sure you can preserve that wealth when a storm inevitably hits.
So why does all this matter? Well, while financial assets can compound your wealth at an incredible speed, it's the real assets that are going to protect that wealth when the whole system feels like it's under stress. And remember how we said they're illiquid? In a world of twitchy, hair-trigger markets, that actually becomes a powerful feature, not a bug. It's like a built-in circuit breaker that stops you from panic selling at the absolute worst moment. A truly resilient portfolio needs to capture that digital growth, but it has to stay anchored in physical reality.
And all of this really leaves us with one final question to think about. In an increasingly complex, digital, and uncertain world, is your portfolio truly anchored in reality? It's a pretty crucial thought for anyone trying to navigate the markets today.